we think it's imperative to invest globally right now. So we're finding some great opportunities around the world. Keep in mind our singular focus is on market leadership and innovation and the bottoms-up fundamentals. And right now we're finding great opportunities, and you're seeing that reflected in the Global Select, where more and more international companies are making their way into the portfolio. If you're an international investor or you're a foreign pension or sovereign wealth fund, and you look at your statement, you've had a 13-year bull market in the US, right? You've had massive outperformance, especially in the technology companies. And so you start to think of your asset allocation. And given what was happening in the US markets, perhaps a lot of noise around tariffs, a lot of noise around how that would impact companies on the op margins or how that would impact the consumer, and you saw a little pullback in the US markets, it gave investors an opportunity to think, well, where else can I allocate capital? So there's some great things happening globally. If you just look at the US markets in general, it is trading at a higher multiple. It's at the 90th percentile of its historical range. The second thing is, and this is part of our house view as well, is perhaps the US dollar has peaked. There's several reasons for that. Perhaps it's questions around economic growth. Perhaps it's questions around the sustainability of it as a reserve currency. But I will say, in general, our view is that a lower US dollar is great for foreign companies, great for foreign markets. Just in general, think of it as a lower input cost. And that's also helped provide a tailwind for a lot of global companies as well. So what is happening globally that we do think is structural and can drive sustained rallies in global markets? I'd say firstly, the idea of European countries being more fiscally loose. They historically ran very fiscally tight. So think of a country like Germany. Germany is now willing to spend. There's $1 trillion of unlock there where they can spend on infrastructure and defense. Another big topic is NATO. The idea of spending 5% of your GDP on defense. This is something the U.S. administration has pushed for. Well, what does that mean for countries to spend more on defense? And so you've seen a lot of European defense companies do really well. And that would also provide a tailwind for U.S. defense companies as well, as you're not going to get everything from European companies. So again, that's an example of where countries and companies are willing to spend more. Another growth engine is if you just think of the advancements in China. Think about DeepSeek and what it really means. So, post-December, post-January 27th, you're starting to see a lot of the Chinese companies really make advancements in large language models, right? And really show you new ways and techniques to train these models. And just in general, if you think about what China's done in the semiconductor industry and how they've vertically integrated everything and the advancements they've made in EVs and now humanoids and robotics, that's going to be another great global growth engine. So again, I'd combine that with the fact that if you look outside of the US, you have a synchronized global rate cutting cycle. So the rest of the world is stimulating, as I mentioned, EU, NATO, China, and you're seeing that reflected in the stock markets. Now, this is not to say that we're negative on US markets or US companies. Our view has been that this is perhaps a little bit of a digestion year for the US markets, right? All else equal with a lot of noise around tariffs and changes in the administration. What would happen to companies' operating income and profitability? What would happen to consumer sentiment? But if you step back, the S&P 500, the NASDAQ, it still has the best operating margins amongst international indices, the best free cash, and it has the largest, most innovative companies. So our view has been that this is maybe a digestion year. So we're not negative on the U.S., and perhaps there's a bit of an opportunity as a catch-up trade, but we do think, given what's happened, it gave global investors just an opportunity to see what else is out there.